Hey guys, SGT here, and I couldn't be more enthusiastic about having on the phone right now one of my favorite people on the planet, James Turk, the founder of Gold Money. Gold Money is a place where folks can buy physical precious metals and have them securely stored in the vaults of Gold Money in different vault locations around the planet. James Turk is also the co-author of the book, The Coming Collapse of the Dollar. Mr. Turk, such a pleasure to have you.
Thanks, Sean. It's a pleasure to be with you.
We're seeing so much volatility in the gold and silver space, but for those of us that have been trying to accumulate these metals for any period of time, we're kind of getting used to this. I know that you've noted that this summer you're expecting a nice run-up in gold. So where do you think we're headed?
Well, let's step back and take a look at the long-term point of view. I'm sticking with my long-term forecast that sometime between 2013 and 2015, gold will be about $8,000 an ounce and silver will be about $400 an ounce. And the ratio between the two metals will be 20 ounces of silver to buy 1 ounce of gold. And I made this forecast back in October 2003, obviously when the price of both gold and silver was much, much lower. But the point I'm making is that we're in a financial bust. And during a financial bust like the one we've been in for several years, and we still have a few more years to go, people move out of financial assets and they move into tangible assets because they're looking for a safe haven. They want to avoid counterparty risk, and the safest of all havens are the precious metals because they're a tangible asset with no counterparty risk. So, from a long-term point of view, I think we're still heading, much, much higher. And you mentioned, the way I approach the markets, which is to continue accumulating. Don't view gold to be an investment. It really isn't an investment because it doesn't generate cash flow. It's really money. And when you accumulate gold this way, you're actually saving money, and saving money is a good thing. At some point in time in the future, we're going to take these savings and either invest them or we're going to spend them or, just continue to hold them. But at some point in time in the future, gold's value will be at a maximum, and you'll want to take advantage of everything that you're saving now through these relatively difficult economic and financial times. With regard to the short term, I am looking for a pop up in the gold price this summer, and it relates back to what happened in the summer of 1982, when the Mexican government defaulted on its debt, and it sent gold up 50% in 3 months and a double in 6 months, a double in the gold price. The circumstances today are very similar. The government ready to default, though, is not Mexico. It's Greece, Portugal, Ireland, maybe even Italy, who knows. But, there are any number of countries that could be defaulting on their debt. And when that happens, I think that could really light a fire under the gold price. So that's why I was making some comments about be prepared for an upside jump in the gold price this summer.
Absolutely. When you made that forecast of $8,000 gold between 2013 and 2015 and 2003, gold was trading around $350 an ounce, and silver at that time was probably around $4 or $5 an ounce. You've been right a very, very long time, and it's your track record, and frankly, it's the way you speak with such sincerity and grace that I think makes people, the common man, the folks that I kind of represent, your message really resonates with us because we view you as a very trustworthy person and a trustworthy source of information. Now, let me ask you this. What do you see as
Before you go on, let me just say thank you for those comments. I sincerely appreciate it. Let me just add one thing because, gold was $350 in October in 2003, when I made those forecasts. But I want to explain that there's no myth or magic to these forecasts. It's really mathematics. And to explain this point, $350 in October 2003, when I was interviewed in Barron's where I made that forecast, was approximately equal to $35 in 1971, allowing for inflation over the intervening 32 years of time. Right. So if gold can go from $35 to $800 in the 1970s, which it did, I was basically saying that history will repeat on an inflation-adjusted basis, taking gold from $350 to $8,000. So, gold really is pretty simple and pretty straightforward. And that's the way I think people really should look at it. It's a form of liquidity. It's a way to protect your purchasing power. Sometimes you want to own a lot of it. At other times you want to own less of it. But gold is still undervalued, and you want to continue accumulating it and ignore the volatility that we're seeing in these markets. On the day of the month that you're supposed to be buying and saving money, go ahead and do it and wait until next month. Over time, a dollar cost average approach like this is going to work very well for you.
Absolutely. Well, let me ask you a follow-up question then on that, because I think when we talk about $400 an ounce silver and $8,000 gold, you're probably using the same statistics of accounting that John Williams would use. And so my follow-up question is, beyond that, do you consider the massive amount of paper, silver, and gold in the marketplace when you calculate how much even higher than that the prices of these metals could possibly go when the paper fraud unwinds?
Yeah, I do in the back of my mind. The problem with the paper part of the market is that we really just cannot determine accurately how much paper is out there. And, there have been estimates. I've always thought it was about 20 times more paper than actual physical metal. But, at the CFTC hearings over a year ago, it came out that there was 100 times more paper than there was actual metal.
That's right.
But, here's the point, Sean. Even if there's 2 times more paper than there is metal, somebody's going to be disappointed at the end of the day if they're holding paper instead of the real thing.
Absolutely.
Because during the financial crisis, there are defaults, and people break promises, governments break promises, banks break promises. And it's this kind of promise breaking that occurs during a financial bust that makes gold and silver so attractive. Physical gold and silver, though, not their paper representatives or paper substitutes.
Absolutely. And I just want to weigh in here for the audience that when we talk about sound money, and when you say that gold and silver in the physical form have no counterparty risk, that does mean that there are no promises on that metal. When you own it, and nobody else can leverage that away from you or steal it through a broken paper promise. I get a lot of PMs, James, from folks saying, where do I keep it? Do I really just buy a safe and bolt it to my basement, or what do you recommend here? And I think at the end of the day, certainly I recommend that, to some degree for somebody who would like to have some on hand for a worst case scenario. But gold money is really an excellent way to go because it's in your secure vaults, it's audited, it's really there, and I think people need to know about gold money. Should we just talk briefly about that before we move on to my other questions?
Yeah, okay. Let me just give you a little bit of background, though, because you hit the nail on the head in terms of dealing with physical metal. When you're buying physical gold or buying physical silver, there are really only 2 ways to do it. You buy it and you store it yourself, or you buy it and you have someone store it for you, which is what we do in gold money. Now, each alternative has different advantages and disadvantages. So, for example, if you buy it and store it yourself, you have it at hand. But the disadvantages are that you may not be able to get insurance for it. There's the risk of theft. And there's also the illiquidity. If you need that gold or you need that silver, you end up having to take it down to the shop and pay various fees, et cetera, to convert it back into a national currency. In gold money, the disadvantage is that you don't have it in hand, but the advantages are that you have instantaneous liquidity in that you can sell it and get the spot price of the metal in any of 6 major currencies and have that wired to your bank account anywhere in the world. Now, the key risk that people are taking when they have gold stored for them by others is you really want to know that the gold and silver are really there. And so what we do in gold money is we have regular audits by 2 different firms, confirming, among other things, that the weight of gold and silver in the vaults is exactly equal to the quantity of gold and silver owned by our customers. And these audits are available to our customers. We've been doing this now for 10 years, and we're storing over $2 billion of customer assets. The other advantage of gold money is that you can store your gold in vaults that are located in London, Zurich, or Hong Kong. So you've got good political and geographic diversification, which again is a way of mitigating your risks when owning physical precious metals, the risk of confiscation by any one government.
Hey, I wanted to ask you this. Which part of the world do you see at greatest risk right now for default? The European Union, the United States, or Japan?
You left out the UK.
Or the UK.
They're right up there with the they're right up there with the others. It's which horse in the glue factory is the best looking. They're all pretty bad. and it's really hard to predict which one's going to go first. But clearly Greece is the sovereign risk at the moment. That's perhaps the one that is worthy of getting the most attention. Their financial condition is just terrific. The government is trying to shove down the throats of the Greek population measures that are unbelievably unpopular. The government has just really screwed it up. The banks that continued lending to Greeks really screwed it up as well. So that's where we should really be focusing our attention. And the European Union has just been making, one bad decision after another in terms of, trying to, bail out these various debtors. And it's similar to the United States in the sense that, why should taxpayers in, let's say, West Virginia bail out California if California defaults on its debt?
Right.
People in Germany bail out Greece if Greece defaults on its debt. There's no logical reason why that happens. The only reason why these bailouts are occurring is because the banks have control of the politicians, and the banks don't want to take the loss, so they're putting the losses on the shoulders of the taxpayer. But that's killing the economy, and the taxpayers have had enough. In Spain, for example, the unemployment rate, the official unemployment rate is 21%. The unofficial unemployment rate is over 30%. And the youth unemployment rate officially is 40%. We have depression conditions in a lot of places in Europe. Greece is as bad as Spain in terms of its economic conditions. And the politicians refuse to accept reality, although it's changing. There was a big election in Greece in Spain this past weekend, where the ruling party at the local level had a huge loss. So maybe there's some changes coming at the political level. The same thing has happened in Germany. But I don't know what it's going to take to shake up these politicians. But this road that they're on is clearly the wrong road. And, I think the demonstrations and political results that we're seeing in Europe and in other places as well to a certain extent are a reflection of the discontent that's growing worldwide with the present system as it's structured.
Well, absolutely, and the reason I wanted to throw the United States in the mix is, I understand what's going on in Greece, as do many of our listeners, but on a economic level, aren't the problems in Illinois and California and many other states in the United States, which are in dire straits, even in worse shape? And now that the debt ceiling has been reached on a federal level, what do we make of this? I think most Americans are in a hypnotic state, and they're just not recognizing how bad things are in this country. So when we hear that Greece is ready to default, isn't that many times a smaller economy than California?
Yeah, absolutely. I'm not so sure that Americans are in a hypnotic state. I think the politicians are in a hypnotic state because they're refusing to recognize the reality that they're running out of money. One of my favorite quotes from Margaret Thatcher is she said, "The problem with socialism is that you eventually run out of other people's money." And that's exactly what we're seeing now.
This concludes part 1. Click here for part 2.